Yes. Get the lights. Okay. All right, everyone. We'll be calling the meeting to order. Good afternoon, everyone. We'll be getting ready to start the special meeting.
Good afternoon. I would like to call to order this meeting, special meeting of the North County Transit District for March 21, 2019. Anthony, please call the roll.
Yes, sir. Jack Feller. Tony Krantz.
Here.
John Franklin. Paul McNamara.
Here.
Jim Desmond. Dave Drucker. Jewel Edson. Sharon Jenkins. Priya Bhatt Patel.
Thank you. We would now hear a safety brief and evacuation procedures from Anthony Flores, clerk of the board.
Thank you, sir. In the event of an emergency, I will dial 911. In the event of evacuation, please do so using the stairs. Do not use the elevators. Once outside, please do not re-enter the building unless told to do so by emergency personnel. We have fire extinguishers on each floor of this building and staff on hand trained in CPR procedures. That concludes my safety brief.
Very good. Thank you. Are there any changes to the agenda?
No, sir.
All right. And public speakers?
I have none, sir.
There are none. So that takes us to our workshop item. One item. Yoon Park Lynch, CFO, is going to review item W1.
Good afternoon, members of the board. I am pleased to present today, introduce today to the board PFM Financial Advisory. Just to kind of give you an introduction, what's the goal of this presentation? As part of our annual budgeting process, both on the operating and capital side, we consider several matters during that process. We have to keep in mind what are our short-term and long-term capital needs that are critical for us to maintain a state of good repair and at the same time to support service levels and to be able to also support our operating costs to provide services to our customers. We rely significantly on funding at the federal, state, and local level. Just to kind of give you a brief overview, approximately 69% of our total operating expenses are supported with these grants, and approximately 99.8%, that's almost 100% of our capital expenses are also funded through federal, state, and local grants. So with that, PFM Financial, they are a firm that has great experience on capital financing planning, also on revenue forecasting and evaluation, debt portfolio optimization. They will be providing an overview of the state of the transit industry and with specific attention to funding, trends, and legislation at the federal, state, and local levels. The presentation will also provide an overview of the district financial ratios, financing options, and other considerations. So with that, they will get started. Yeah.
Good. I guess it's afternoon. Good afternoon. Thanks for having us. Appreciate the introduction. We'll just go a little deeper in introductions. I'm going to start on page 3. And before that, I'll just introduce myself, and then Darren can introduce himself. I'm Peter Schellenberger. I am a managing director with Public Financial Management, PFM Financial Advisors. We are a financial advisory firm. That is our sole business. We work with public entities such as yourselves and advise on long-term financial planning. And if and when there's any debt or transactions that occur, we advise on specific transactions. We do not underwrite. We do not sell securities. So we're strictly an advisor. I've been with the firm for 18 years, and prior to that with KPMG in the transportation planning space. And so that's the angle that I sort of have focused on in this business: transportation planning, financial and transaction management. So I'm out of the San Francisco office. With that said, born and raised here in San Diego, Pacific Beach native. So good to be here.
Afternoon. My name is Darren Hodge. I'm a director. I work out of our Chandler office in Arizona, so a little bit east of here. My background is in investment banking, both with JP Morgan and Citigroup, focusing mostly on transportation west of the Rockies. So currently I work with Peter in the Western region transportation, basically covering transportation clients west of the Rockies. A lot of our transit clients range in size from small little mountain transit agencies, Simply Bus, up to the largest transit agencies, including LAMTA. So happy to be here, and thank you for the time.
And page 3, very quick overview of who we are as a firm. Again, independent financial advisory firm. We were founded in 1975. We're headquartered in Philadelphia. We have, 38 offices. I'm out of the San Francisco office. We also have a Los Angeles office. Darren comes from Phoenix. Darren and I mainly work in transportation, so some of the peers that we have the pleasure of working with are San Francisco MTA, Los Angeles MTA, Phoenix Transit Department, Alameda AC Transit, Sandag, longtime advisor to Sandag, Sacramento Transportation Authority, et cetera. So we bring a specific focus in transportation here. And that's about all we'll say unless there's questions on us as a firm. Now we're going to launch into sort of talking about the transit industry at large. So, unfortunately, no, no.
He taught him his swing.
That's right. I corrected. I shouldn't say taught it. I just corrected. Yeah.
All right. Before we jump into the overview of the transit sector, we're going to talk a little bit about the market and the economy. So as we go through this, there's going to be some contradictions, as everything in the economy is today. There's going to be things that look good, things that don't look good, but it's all going to come together at the end. And then we're going to end with a little bit of discussion of what to expect next. Potentially. Potentially is a big word with the economy. I could tell you what I think, and I can guarantee you I will be wrong. So, first page, generally the US economy is doing quite well. And when you look, there's many different metrics we could look at to determine that. We just picked 4 here. 4 of the big ones. The unemployment rate continues to decline. We're right around 4% right now. Consumer confidence continues to increase. You and I, all of our compatriots, we are all buying more goods, which is good for the economy, good for sales taxes, good for property taxes. Average hourly earnings continue to increase, which helps increase our spending and buying power. And all that relates to the domestic GDP continues to improve and continues to increase. So overall, the domestic economy is favorable. Okay, now let's look on the global scale. So one of the good things and bad things about technology is the flow of information. We can tell what's happening in the world instantaneously. So what happens in Greece, what happens in Spain, what happens across the world is digested in the municipal and taxable markets almost immediately. And so what's happening on a global scale is that for the most part, there's a lot of news that's concerning investors. And so what's happening with regards to South America, Europe, Brexit, everything, that immediately impacts our markets, which we'll talk about a little bit more. One of the other trends, as we just mentioned, a slowing in the global economy. So there's a couple different trends that we've been following. One is the OECD leading indicator. And there's several of these different, the OECD nations, by the way, it's an organization for economic cooperation and development. It's about 36 different members ranging from Australia all the way to some European countries. And so this is just a leading indicator of how they are seeing the global economy. And as you can see, the trend is for the most part been downward. So there's projections for slowing in the global economy. And that's supported, if you look on the top right there, the IMF global growth forecast. For the most part, some of the largest powers in the world are expected to have slowing growth over the next several years, including United States, China, and Japan. And then when you look at further evidence, the global market purchasing managers index, you look at market, that's actually not misspelled. Name of that company is market with an I. What's been occurring over the last several years has been an expansionary period in terms of this index. However, since 2018, there's been a decline, and we're right about that point where they have measured it to be potential contraction. So from a global standpoint, there's concerns. We talked about on the domestic front, things are looking good globally, a little bit more concerns from the investor's perspective. Now, let's get to the Fed. Let's go back to the domestic side a little bit more. Because our domestic economy has been doing so well, that's been the impetus for many of the Fed rate hikes. So we've all heard about it over the past several years. The Fed's meeting, they're seeing inflation, trying to control it. They're seeing the strong unemployment, they're trying to control unemployment. And they do that with one of the tools they have, which is raising the Fed funds rate. And so what this chart represents is since December of 2015 to now, how many times the Fed funds rate has been hiked. And currently the Fed funds rate is over 2%. What that essentially means for us as an economy is that Fed funds rate, if you remember back to the last recession, that was one of the primary tools that the Fed had to encourage borrowing, encourage spending. They lowered that Fed funds rate, which encourages businesses to borrow at the overnight rate much more frequently and in greater size. What this allows them to do is have the flexibility, should the next downturn occur in the next several years, to be able to adjust with the market in this way. Now, looking forward, this presentation was completed yesterday. There's been an update since then. So as of Monday of this week, we thought the Fed was going to increase rates twice this year. The market didn't expect any more rates, but most of the people took the Fed action and said, okay, based off the reports, we think they're going to do it two more times this year. They came out yesterday and said, you know what? We don't think that the outlook's as strong as we originally anticipated. We don't think there's going to be any more rate hikes till 2020. So as we mentioned, the economy moves pretty lightning quick. Our presentation's already out of date. So what does this all mean? Peter and I, we live in the capital markets world. So when we think of all these actions, we think about from what does that do to interest rates? How does that impact tax exempt rates and taxable rates? And the great part about the fixed income markets is you can look at interest rates and they tell you a story over time. Why things are occurring, when things do occur, how they're impacting us. And we break this up into two sides. So let's look at the short term, the short end of the market, or short end of the yield curve and a long end of the yield curve. The short end of the yield curve has been driven in most part by the Fed fund rate hikes. So the actions of the Fed. And that's exemplified. If you look here at this red line, that's the 5-year MMD rate. What MMD is, it's a index that's used in the tax exempt markets as our benchmark. So think of it like the treasury rate, but the tax exempt equivalent. So as you'll see, starting in January of 2013, all the way to January of 19, that 6-year period, it's been almost a doubling of that rate. So it's increased pretty substantially, in large part because of the actions by the Fed.
And we might just give an overview of what a 5, 10, 20, 30-year rate or yield means.
Yeah, so if 5-year MMD rate, it's just what you would pay if you bought a bond maturing in 5 years, 10-year rates if you bought it in 10 years, 20, 30, and so on. So in general, what you'd expect to see is that if you buy a 30-year bond, because you're taking 30-year risk, you want to be compensated for that versus a 5-year. So you'd expect your 30-year rate to be higher than your 5-year rate. So the short end of the curve is having upward pressure as a result of the Fed funds actions. But what we talked about on the long end of the curve was the overall economic environment. When investors look at the long end of the curve, they're thinking more, what's going to affect me the next 5, 10, 30 years? And what they're seeing on the global level is a lot of uncertainty. Anytime you see uncertainty in domestic, global markets, any of the markets, investors typically flee to fixed income securities. So what that has the effect of doing, if they buy more fixed income securities, our yields go down. And so if you look, there's that blue line right there. That represents our 30-year rate. That's remained pretty constant over this time. So you've had this dynamic where your long-term rate stayed pretty consistent. Your short-term rate has increased. What that's led to is what we call a flat yield curve. What a flat yield curve is when your cost of borrowing on the short end is very close to your cost of borrowing on the long end. Why is that a problem? Because essentially investors aren't being compensated for taking additional risk. Now, as we'll talk about, that has some implications of potentially forecasting economic slowdowns. So before we get into the negative part of this, any questions, comments, reactions, wanting us to stop? Okay, we'll take that as a positive.
It may just be worth just connecting those two concepts to sort of a flat yield curve, increasing short-term rates, long-term rates have held in there, and then Darren just walked through on page 8. The Federal Reserve has increased rates how many times over the last 6 years? 8 times. The short end rate, that red curve, the 5-year yield, has really been driven by the Fed's policy of increasing short-term rates. When they increase short-term rates, it'll impact those sort of 1 to 5 year rates. It really has very little impact on the 30 to 20 year rates. And so we're not seeing much inflationary pressure push up to 20 and 30 year rates. We're seeing the Fed policy push up to short-term rates. So they're starting to compress and get very close to one another.
Mm-hmm. So on the next slide, in slide 10 here, what we like to take a look at is just a recessionary cycle since 1980. Typically, if you look at the math over the last century or so, recessions occur every 7 to 10 years. That's just, it is part of our economic cycle. We boom and then we bust. The most recent recession occurred in 2009. And so from a mathematical standpoint, if you, on average, see a recession every 7 to 10, unfortunately, we're due. There's obviously no way to predict that. Our economy today is both internally driven as well as exogenous forces. So there's a lot of factors in play that very difficult to predict. But what we can look at is near-term trends to figure out what's the risk in the near term to get a better sense of, as we talk about our planning efforts in the near term, what should we be looking at? And so on the next page, one of the leading indicators, just one, there's a plethora of them. One of the things we look at is the 10 to 2-year U.S. Treasury spread. What I mean by that is what's the difference in yield between the 10-year Treasury rate and the 2-year Treasury rate? Again, going back to in a normal economic environment, the 10-year rate should be higher than the 2-year rate, because if I'm buying a 10-year security, you have to pay me for holding that versus a 2-year rate. You've probably heard in the news, yield curve inversion. Anytime the yield curve inverts, that's seen by many economists as a sign that potentially a recession is on the horizon. And if you look at that top chart, what I've got there in the gray bars, that's a recession. And so if you look at the year or two right before each of those recessions, in most of the cases, what you'll see is that blue line dips below that bar. What that represents is that is when the yield curve is inverted. And so that's why when economists look at this, they say a yield curve inversion is one sign that potentially a recession could be on the horizon. Big question we always get is, well, why? Why does a yield curve inversion mean that a recession might be on the horizon? The reason is because if you think about from an investor's perspective, if I'm earning a higher rate of return on the 1-year security versus a 5-year, what I'm telling you is that I am willing to accept the lower yield for a longer period of time because I think over that time period, a recession is going to occur, interest rates are going to drop, and I'm going to be better off overall. So the market's telling you what they are predicting. The other part of that is almost self-fulfilling. The more you jack up short-term rates, the more expensive it is for us as business owners to borrow money, invest, reinvest. So we stop investing, we stop hiring. And so in a sense, it kind of foretells itself. So with that, let's end on a positive note. However, everything that we just talked about, right now, from what our economists are saying, we don't see anything on the immediate horizon. I'm not going to define what immediate is. We're just going to say, make 12 months, we'll say. We don't see anything that indicates anything that near term that might trigger a recession. And so there's a couple things we look at here. Obviously, we looked at the yield curve inversion. Right now, we're still above the inversion rate between the 10 and the 3-month Treasury. I will say that part of the Treasury curve is inverted, but this part that we look at is not yet. Industrial production is still growing. It declined a little bit in 2015, but it's still on an upward trend. Conference board leading indicators still on a positive upward trend, and jobless claims continue to decline. So 4 important factors that typically when you look at a recession, you might be able to use as predicting indicators, all look pretty good as of now. However, you look at them, they are starting to see trends and little triggers where if they start to reverse their trends, could lead to something. If I'm,
He might, I know. I
depends on how much sleep I want to get that night. I typically track them every week, to be honest. I'll look at some of the most important ones on a daily basis, like the Treasury curve, just because within our borrowings, we need to track on a daily basis how the interest rate movements are affecting our debt. On things like the leading indicators, jobless claims, I'll look at those on a monthly basis or as they're released. Those are more trend-based. You're looking at those over a quarterly, annual time period. Daily, they're not released even, and sometimes it's almost overload of information. Okay, any questions on the economy?
Clear as can be, I'm sure.
No one's too depressed? We're all feeling good? All right.
I mean, one takeaway is rates are still low. I know the stock market's been fairly stagnant. Great deal of volatility, but from an interest rate perspective, where you go about and access the capital markets, borrowing in the tax exempt, those rates are still quite low, even though the Fed has tried intentionally to increase those. Those middle and long-term rates just haven't followed suit. So investors are not terribly concerned about inflation, et cetera. Still a pretty good time to access borrowing at low cost. Today? Yeah. Volatility yesterday was down about half that. You can do, I think, the next two.
Sure. Okay. So now we're going to go over an overview of the transportation sector. What we want to start with is let's just look at some of the trends that we see. And this is not all encompassing, but we just wanted to pick out 6 different categories, if you will. That is, as we work within our transit clients throughout the Western US, what we see as topics people are thinking about, concerned about, and that we address. The first is synergy with economic development. What we mean by that is it's just a well-known fact that transit drives economic development. You can probably see that every time you expand service, you put in a new station, property values increase for the most part around that area. And developers are starting to see that, communities are starting to see that, and so they're trying to figure out ways, how do we synergize all of this together to get value? Second, technology, the benefits and the challenges. That's pretty self-explanatory. For transit, technology can be a benefit. It can also be a challenge. Sometimes it can be both when you're talking about ride sharing, for instance. Seems to switch on a day-to-day basis and transit agency by transit agency. Increasing state of good repair needs. It is expensive at times to maintain what we need to maintain on the capital side. Environmental regulation is another thing that pretty much every transit agency, particularly in California, is addressing and needing to deal with. And the 6th one is ridership trends by mode. When you look at certain modes, they are struggling over the last several years, where the others are really taking off and doing incredibly strong. And you see trends among that within the state where bus ridership in a lot of areas is simply down as the economy improves. Yeah.
Can I go back to your first bullet? It's okay to ask questions now?
Oh, absolutely.
Right.
Absolutely.
You said the synergy with economic development, and you talked about how whether a transit station is put in, you see economic development build around it. I assume that's a national trend, or is that, I'm not sure I believe that in San Diego County, right?
It's true.
It might be true nationwide, but is it true in the San Diego County?
Well, I'm not going to say that I have the data off the top of my head, but the analysis, and I can find you the analysis from an industry point of view, that where you make an investment in a permanent infrastructure for transit, So for example, where you build a rail station that has a permanent development and infrastructure, that the property value around that typically is higher valued property than a location that does not have that permanent development in it. So I'll pull together some of the national studies that have been done. Part of that is going to also be addressed specifically for us as part of a public benefit study that I think is that on our agenda today for approval. But it is a fact.
Can I? And certainly nationally, I mean, it's a good point. The time and when does that value realized does take some time, particularly with, for instance, Phoenix. We work in Phoenix, Sunbelt City, fairly low development. Here they're expanding transit. They're looking for sort of increased value around station areas. It's going to take some time. San Francisco, it can realize it immediately with their new transit center up there.
Yeah, and I mean, because I don't see the direct correlation necessarily in San Diego County, where you would expect, you know, the property values may go up, but we certainly have economic development areas that have developed that don't have transit there.
Sure.
And that's been one of the Sandagan issues that we've been talking about for a while.
The baseline of what is talked about is that the property value at those locations where there's a transit investment, and it's a permanent, it's not a bus stop, as an example. It's a rail station or a bus rapid transit station facility that's permanent, is that when you compare that on apples to apples, that property value would be higher than an area that does not have that infrastructure. Now, think about it from an intuitive point of view, particularly if you're trying to locate a business. Part of the decision-making factor in terms of businesses and determining location is transportation, ability to get to workforce to work. I used to manage a statewide program that totally focused in on how we locate businesses to support their operations and being able to move the labor in and out of that workplace. So it's very intuitive that where you have that kind of infrastructure, you end up creating more of a density, and as more of the density is created, the property value and the cost per space ends up being higher at those locations.
That's if the community is willing to accept and approve density around the transit station,
Absolutely.
which was one of the main obstacles we have in San Diego County. So,
Well, and San Marcos has some prime examples, I think, with the development that's happened around Palomar College and CSUSM. So, you know, maybe some of the facts that would derive from that would come out of San Marcos.
well, and true, and so we've capitalized on that transit side. I'm just saying, and that was an uphill push. We had a referendum against that project, and that fortunately failed. But unfortunately, the sentiment isn't always agreeable, I guess, to have these projects in place, or to even put the densities around that you're talking about will increase the property values. Where if you've already got property values around a transit stop in Sanitas or some of the more affluent coastal areas, that we don't always have the willingness, I guess, to put in the housing or the density that the transit needs.
Mhm.
And I guess just on this fact that so we've been putting in a lot of transit. Sandag locally has put like 2/3 of the dollars in the last decade into transit, yet our transit ridership is down. So how do I don't get, I'm trying to wrap that around in my head, along with the fact that transit's going to build the economy. I'm just struggling with this slide.
I want to, so what I would say, they're really here to talk about the economics and the economy. I can talk to you more about what has happened from a transit utilization point of view. We're trying to focus this presentation to set the context for you all about our future financial planning and budget activities. So we can talk a little bit later. I'll put an agenda
Well, I
item.
get that, but I guess with the transit with the economy, I get that. But if nobody's using it, then it's, or there's fewer people using it. Yeah, I don't think you can just rule that out. But go ahead. I'll let you.
I would
I don't want to get you too far off track.
Yeah, I prefer to keep these guys moving.
Reality's out there too. Okay.
Okay. So on 15, and we won't go through each of these in detail, what we wanted to do here is just give a snapshot. When you look at transit funding, by nature, transit funding for the most part, is pretty diverse. We try to get our revenue sources from a variety of areas, federal, state, and local. What that allows us to do is to try and hedge ourselves as best we can against volatility among certain revenue sources. Sometimes that's not always as successful as we'd like, but by design, there's a lot of different sources we look at. And so this is just a sampling of some of the major sources. We're going to go into more detail on some of the large ones, but hopefully this can just kind of be a reference for the future. If you look back and there's talk of a certain revenue stream, this might be a good reference point to say, here's what that is.
Any questions before we sort of move forward here? Page 14 is interesting. We don't always use that slide, but it's almost a hot button page. You could call those 6 buttons because it's not a pro or con. It's just topics, and folks have very passionate positions on these.
And that's why he lets me talk to it.
Yeah, Darren nailed it. Darren nailed it. So we're going to move forward. Taking a step back, I think the goal here is just to provide context and a framework. This is not going to sort of lead to sort of a clear punchline at the end of this. So this is all really just contextual information. So as you have questions or really comments or additional insight, feel free to stop us. That said, I'm going to start at the federal level, talk about federal funding, and then Darren's going to take us sort of through the state and local concept. Page 17, broad overview with a look back to 1956 through current day of how federal funding has kept pace, or more to the point, has not kept pace in terms of meeting our national transportation needs. The graph on the left shows in constant 2017 dollars, so adjusted for inflation over that period, what the contribution from the federal government, which is the lower red line on the left, compared to the state and local government in terms of meeting our transportation funding needs. And so the takeaway is federal funding has been stagnant. We'll talk a little bit about why that is. And that has really shifted the burden to the state and local government. And so that plays out very poignantly here in San Diego, as board member Desmond points out. You know, Sandag, much of this local sales tax dollar has flowed into the Midcoast project. That said, these numbers, a lot of these dollars for the competitive grants, particularly through the CIG or the Capital Investment Grant Program, are competitive. And so San Diego's done relatively better compared to the some other areas. It has $1 billion discretionary grant flowing to that project. Everybody has their position and their opinion on that. But just in terms of dollars flowing, there are sort of more federal dollars flowing to at least project specific in San Diego. That does not take away from the fact that you and every other locality and state has had to pick up for very stagnant federal funding. The other takeaway as a transit agency is most of these, probably about 65 to 75% of the federal dollars are flowing to highways versus transit. Page 18. Yeah, it's going to vary over time, but, and I've got it on a following page. For instance, in 2018 from the Highway Trust Fund, the outlay was $55 billion. $55 billion of outlays through the Highway Trust Fund in 2018. $45 billion of that was going to highway, $10 billion of that was going to transit. So in 2018, it was about 20% to transit, 80-20 split. Good question. So on 18, why the primary mechanism for funding transportation on a national level is the Highway Trust Fund. The primary funding source through the Highway Trust Fund is an excise tax on motor vehicle fuels. It's not a sales tax; it's an excise tax. So for every gallon of motor vehicle fuel pumped into a car or a truck, 18.4 cents goes to the Federal Highway Trust Fund. 18.4 cents. That's been 18.4 cents since 1993. So it's not indexed to inflation. It's not a sales tax that as the price of goods go up, it follows with it. It's just a flat excise tax. It's per gallon. So two things have occurred. One is the purchasing power of that 18.4 cents has decreased over time. It's worth much less than it was in 1993. And we're shifting towards more fuel efficient cars, partly due to mandates and environmental mandates, and partly due to economics and the cost of fuel. So through that, the contributions on a relative basis from the Highway Trust Fund has been declining. I've already noted that in 2018 outlays were 55 billion, 45 billion of that highway, 10 billion of that transit. I think that's the takeaway on page 18 in the Highway Trust Fund. It's long been discussed, well, we've got this excise tax that doesn't grow with inflation. What should we do? We should index that. We should index the, one suggestion, we should index this sort of excise tax to inflation, so it grows with time. The interesting thing is there's very little will at the federal level to do that. It's viewed as an increase, a tax increase, very, very low consensus on increasing taxes. So you're now getting localities that are indexing fuel. They're kind of trumping the federal move in the Highway Trust Fund. So if you look in the state of Nevada, both Las Vegas, the Southern Nevada Regional Transportation Commission, the MPO in Southern Nevada, and the MPO in Washoe County up in Reno have now indexed fuels. And they've indexed, when they did that, it's been done over the last 10 years and done twice through various ordinances and bills in Southern Nevada. They took the base of federal, state, and local excise tax, which was about 64 cents or so in Southern Nevada, and indexed that to the PPI. So I think the interesting takeaway there is you're getting localities that are already taking the component of federal excise tax, federal fuel, and indexing it themselves. So nobody's waiting for the feds to do it. Localities are doing it themselves. Page 19, here's a quick look at the current legislation in place, the Fixing America Surface Transportation Act. Over the last, and I'm sure you are more aware of this than I am, over the last 30 years, transportation has been funded generally with the goal being 6-year bills through Congress, where programs and largely programs through highway and transit are identified and funding limits are set. The FAST Act was the most recent. Prior to that was MAP 21 with a different acronym. It goes all the way back to ICE-T in the 90s. And, you know, these 6-year appropriation bills identify a specific amount for specific programs, and FAST identified $305 billion through 2016 through 2020. It's about $51 billion annually coming from the feds to fund transportation, $51 billion. And you could just sort of see the obligation limitation on page 19. Those are the dollars that should flow throughout the country. Page 20, yeah.
So the difference is about 18 billion. Where is that?
From 18 billion in terms of the 351 billion versus
305 billion almost.
Mm-hmm.
And it's broken down into 226 and 61. There's a difference between that 305 and those two. So there's another.
Yeah. So this is just highway and transit, but that's exactly right. Yeah, there's some freight in. Yeah, I'm gonna go work there. Page 20 points to kind of the challenge in the culmination of these different dynamics. You have about $51 billion of outlays on an annual basis, expenditures from a federal perspective. The Highway Trust Fund is really just bringing in at about 41 billion on an annual basis. So there's a gap to be filled every year. Here's a study from the Congressional Budget Office, and what it shows is that really the Highway Trust Fund and the ability to even maintain the stagnant $50 billion annual expenditures is reliant on subsidy away from that fuel tax that flows to the Highway Trust Fund. And just to give you a sense here, if they renew the FAST legislation, the FAST Act, for another 6 years, carry that through 2029 and keep the expenditures at 50 billion. Okay, if they do that, knowing what the Highway Trust Fund would bring in on an annual basis, they'll need another 95 billion from the US General Fund or a new tax source just to keep pace with current spending. So that's what this graph tries to get to. I'll say that again. Given a constant level of expenditure of 50 billion over the next 6 years, assuming all the dollars that flow in through the current excise tax and taxes to the Highway Trust Fund, they'll still need another 95 billion appropriation from the general fund just to keep the Highway Trust Fund solvent. So that's a real challenge at the federal level. And if you carry that all the way through 2029, this trust fund says, hey, you need this graph says you need another 165 billion from general fund from the US or a new tax source. So the Highway Trust Fund is just not cutting it. It's a matter of political will. And in the meantime, the continual shift of the burden to the state and locals is sort of how that plays out.
Has there been in the past any monies, I guess, in the previous years, 2016, 17, 18, it looks like there's more monies came in. Has any of that been general fund money, or that's all? So there has been some backfilling from the general fund in the years to, okay, make up the differences.
If you
So
look
this is
at
not new.
if you look at the CBO study from 5 years ago, you take this graph and you shift
Just
it
shift it
back.
5 years.
And so what's
Okay.
the continual solution has been general fund transfers from the.
And so the key piece, and this is just one of the nuggets that we want you to capture, is with them using general fund dollars to do this and becoming it more and more reliant upon this. If you overlay this with the debt level that the federal government is approaching, this is $1 trillion a year. And if you throw that into a middle of an economic recession and continued political gridlock, for the transit agencies and for the transportation agencies, highways, there could be some years of real big pain coming down the line if we're not able to get any form of consensus about how to fund these programs. The other piece of it is where it creates all of this uncertainty about how do you plan. And it's not about planning for 10 years. It's about being able to plan effectively over the next 2 to 3 years in terms of where funding is going to be. So that's why this is so significant that you pay attention to this as you hear about this on the news, because this will be a big deal issue, and it will be a bigger deal issue when that recession comes and figuring out how they will solve this issue.
The other, a little bit of color to that as well, is the color of money that flows through the Highway Trust Fund. From a transit agency's perspective, there's some certainty, at least, to that 41 billion that comes from the excise tax at flat 18.4 cents that flows to the Highway Trust Fund. There's some certainty to that flows to transit agencies. That tends to fund your formula programs like your 5307 funds and your 5337 funds. That's not the source of funding for the capital investment grants, which is the source of money for the Midcoast project, for instance. You know, that's a capital grant program, but that is dependent on a congressional appropriation from the general fund. So when you start thinking about where's my future dollars for capital investment coming, if it comes from the capital investment grant program at FTA, it's probably going to be funded outside of the Highway Trust Fund. And there's a little there is less certainty that will continue to be appropriated by Congress every year.
And so the key takeaway, one of the key takeaways from this section is that it's a trend we've been seeing over the last several years, and it's even more pertinent today. You can see going forward, the responsibility is being shifted down. So we as transit agencies or regional transportation planning agencies are having to do more with less and more for ourselves. And so that then gets us down to the state level. So what we want to do in this section, just talk a little bit on a statewide level. What is the state doing from a transportation and transit specific funding and expenditure standpoint? And one of the first things we like to start with is the CTP 2040. So it's the state's transportation plan through 2040. And it's a very broad, inclusive document, but the key takeaways that they try to come up with is they say within their long-term vision of where the state's going to head from a transportation standpoint, they want to set up policies and recommend certain actions to make sure that we can implement, fund these projects to continue economic growth. And what they identify as some of the key funding challenges within the next 30 years is some of the points that Peter hit on. The first is that fuel excise taxes have not kept up with inflation. Couple that with declining fuel consumption, mostly due to the fact that our vehicles are simply getting more fuel efficient. And then also combining that with the third leg of that stool, which is impacts of the Great Recession. So a lot of our transit funding comes from sales taxes. Well, we all know what happened in 2008 through 10 with sales taxes during recession. They declined double digits. And so if you decline by 50%, you have to increase by 100% just to get back to break even. And so anytime you have a recession, you're essentially put behind the mark, and then you've got to accelerate to keep up. And so within the CTP 2040, the state identifies certain funding solutions. They're not saying that they're going to implement these, but these are certain solutions that they're thinking about and that people can fund or implement on their own. The first is, as Peter mentioned, some of the other states are doing, indexing the fuel excise taxes. The second is looking at it as a pay-as-you-go tax and fee basis. What they mean by that is you've probably heard about vehicle miles traveled. People are thinking about, are there ways that the state can track vehicle miles and tax based off that? The other thing that is included in pay-as-you-go taxing last that they look at is just additional taxes for transportation, which came in the form recently of SB1. So if we go to the next page, right here, we're going to go through a couple of the main funding sources for transit in California. So in general, there's two primary ongoing sources of funding that we receive for our operating and capital expenses. The first is the State Transit Assistance Program, or STA. That's generated from a diesel fuel sales tax. The second is the LTF, your local transportation fund. That's generated by a 1/4-cent sales tax statewide that's then distributed down to the local entities. Those are the two primary sources of ongoing state funds. Then you've got other grant funds like Cap and Trade through LC TOP, TARCP, and the Affordable Housing as a Sustainable Communities program. And then as we'll go into a little bit more detail in the following slides, SB1. SB1 was obviously a pretty big source of new revenue, an expansion of existing revenue for many transit agencies throughout the state, and NCTD was no exception to that. So just some quick background on SB1. I know everyone's probably very familiar with the bill and what it implemented, but essentially what SB1 did was it created some new and increased existing taxes and fees. Most of those have already taken effect. There is one additional fee that will take effect in a few years. In general, what they were predicting at the time of this bill was over the next 10 years, $52.5 billion of additional funding for transportation agencies statewide. Now, as it relates to us, so transit operations and capital expenditures, there's two components of this bill that primarily affect us. The first is there's an existing sales tax on diesel fuel that was increased by 4 percentage points, so from 9 to 13%. That's expected to generate about $294 million per year for transit. The second is they created a new transportation improvement fee. That fee is based off the value of your vehicle when you pay your registration fees. That's supposed to generate about $400 million for transit-specific projects, about $250 million for a separate transit-eligible program, which we'll go into. So on this page, it might be a little hard to see, but what we did here was we broke out transit-specific within SB1. What are the various sources of funds that go to transit? And if you look right here down at the table, we'll focus primarily here. We shaded the brown color. It might show up a little gray. That's essentially an existing program which SB1 expanded funding for. The orange shading is a new program that was created by SB1. And so if we go through these, the first one was the State Transit Assistance Program, so the STA funds. That was an existing program. What SB1 did is it increased that funding by 3.5 percentage points. Well, it was by 4 percentage points, as you remember, but within that 3.5% goes to fund capital and operations for transit only. And that's a formula fund. We'll just jump right down here to state rail assistance. The other 0.5 percentage point of that 4% goes to fund capital and operating, and it's divided 50-50 between intercity rail and commuter rail. If you then go to, let's just go down the order, state of good repair. So within the STA program, state of good repair, the transportation improvement fee, that was that fee that's based off the market value of your vehicle. That's about $105 million a year that goes to state of good repair capital needs, and that's a formula fund as well, new program. Another new program was the State Rail Assistance Fund that we just went through, that 0.5 percentage point. TIRCP, that was an existing program. It's getting supplemental funds through that TIF fee. Expected to generate about $300 million. It's only for capital projects for transit, and it's a competitive grant program. The two last programs that were generated, new programs that are SB1, Solutions for Congested Corridors program, again, funded by TIF, $250 million, and it's for capital projects and congested corridors. It's transit eligible, but it is spread among a number of different project categories. And the last is the Local Partnership Program, expected to generate about $200 million for high-need transportation projects. So now, how did this impact NCTD? So just quickly, we divided this up into some of the formula funds and also the competitive programs that NCTD has achieved and will be competing for. So in terms of the STA funding that NCTD receives, as we just talked about, SB1 significantly increased that. And if you look at this chart over to the right, what we did right here is we tried to track the last 5 years since 2012. What were the STA funds that you received? And as you'll see, it tracks pretty level, slight decline. However, once SB1 was implemented, you'll see that blue line increases pretty significantly. That's because of the additional funds that you're now getting through the STA program. And in addition, what we added down here was the new program, the State of Good Repair funding from SB1. So you're almost getting two sources of different revenue, which have increased your overall STA funding pretty dramatically. And then from a competitive standpoint, we went through a few of the competitive programs that you have to compete for. One of those is the State Rail Assistance Program. And Matt, you can correct me if I'm wrong here, but it looked like we were awarded about $10.5 million over the next few years to help fund the purchase of the 5 locomotives.
So that was actually... So it's two pieces. We received $10 million through the Air Pollution Control District, through the Carl Moyer program, and we are using SB1 State Rail Assistance money for the locomotives, and I think we've already received $10.5 million of funding towards that as well. So it's significant towards the overall purchase of the locomotives, which is $38 million.
Well done.
Okay. So moving along, we just talked about some of the state funding. The other important component as we look at doing more for ourselves is really the local component. And so we took a look at two important plans on 28 and 29. The first is the regional plan through 2050. The second is the 5-year RTIP, which is a little bit shorter looking capital plan. So the regional plan through 2050, it's updated, it was last updated in 2015. I believe it's currently in process of being updated. So this might be a little bit dated, but the trends and the ideas that were in the 2015 plan are still relevant for the most part. And so the 2050 regional plan had 3 objectives in mind over this time period. Wanted to provide innovative mobility choices, support a sustainable and healthy region, and 3, support a vibrant economy. And one of the expectations and one of the broad trends, and Board Member McNamara, this gets to a little bit of what you were talking about, was within this plan, broad strokes, one of the thoughts was that over the next 30 to 40 years, the growth may occur up. As density increases in certain areas, the growth is going to be a little contracted or constrained to expand out in the growth up. And so when we talk about how transit fits in those situations, I know it's not applicable to everywhere, you'll start to see on a marginal value, more marginal benefit to transit in those types of situations. So that was one of the plans through there.
Just a comment.
Yeah.
Thank you. But the way I'm thinking of this, and correct me if I'm wrong, is I see an area that's not very developed or empty space, and that's the before picture. Transit center comes in, and 5 years later or some amount of time later, I should see some sort of growth, right? I think we saw that in San Marcos with the Sprinter, right? But the question is, in my mind, is that because of the Sprinter or because of Cal State San Marcos?
Well, it's a combination of a lot of different factors.
Well, I mean, I could go to Escondido and look at our station, and
Well,
I'm not seeing that.
well, because it's more than
So I'm kind of like,
no, it's more than one factor. But the fact of the matter is, most people who are making those types of an investment, and so you use the transit center as an example, but most communities, and if you go and look, and I found the literature, and I'll send it out to the board, what goes along with making that investment is also the public policy to support.
Yeah, 'cause that's kind of what I'm thinking in my mind.
Right. Well,
Where is our growth, and is it bad public policy? Is
so
it
so
some
think
other
of,
factor that I'm not aware of?
so it shouldn't be that complex. So think about the interstate highway system. So would you agree that development occurred in US that was largely spurred by the creation of the highway system?
Sure.
It's the exact same principle. When you put those kinds of infrastructure plus public policy investments, you end up yielding that. And in the case of transit, particularly in any area, the development of the value will be intensified based upon making that investment.
Right. Yep. We need to review our public policy then maybe. I don't know. I want the after picture.
To address specifically, so to address this specific example, and we'll do a separate workshop on land use because we have a presentation and a study going. So this is very timely that you guys are disengaged on it. But if you look at the Escondido Transit Center as an example, for lots of different reasons, largely driven by money, there hasn't been the development. We've had a project, we had a study that was that's probably more than a decade old. It was called the CEO study, Carlsbad, Escondido, and Oceanside. And it identified these three locations as prime locations for transit-oriented development projects, okay? Now, if you actually made the investments to create both the commercial and residential development around those locations and created the property investments in the public policy, the property values around that actually would be exactly higher, just like they are in almost any other city that you would go to. So again, it's tying things together for lots of different reasons. If you look at the Solana Beach Transit Station as an example, well, we have to figure out how do we align public policy with that piece of infrastructure to come up with a development project that supports our goals. And I would bet that property value there will be higher compared to comparable property value within Solana Beach. So it's aligning a lot of different factors together to bring them together. And they're hard because if you don't bring all of it together, you don't get the benefit.
So I think I believe it's tougher in a city where it's infill development than in a city where you've got certainly wide open spaces or you've got a blighted area or something like that. My city is a little different because this is right in the middle of the action, right? Where we want to develop this train station and bring even more vibrancy to that area. I don't think it's going to fail either way because it's a great location.
So one of the other interesting things to look at over the next 30 years is what the regional plan expects in terms of expenditures. And what you'll see is that there's a lot of different expenditure categories, but these two top ones right here, transit O&M and transit capital, make up about 50% of the expenditures. So essentially what this is saying is there's a pretty big expectation of investment in transit. The next page on 29, which we'll briefly go through, is the 5-year RTIP. This is a 5-year program of transportation projects in the San Diego region. And just big picture, same thing. What you're seeing is on an expenditure standpoint, a pretty substantial investment in transit. So you've got your major transit capital programs, and then O&M represents about 70% of this orange slice. So again, about a 50-50 split. Transit's getting about 50% and other forms of and modes of transportation getting the remainder. From a funding standpoint, our local portion, our local funds, will make up about half of the funding sources. We'll get about 25% from state and the remainder from federal. So the takeaway here is that our local sources of funding are still going to be our primary drivers. And why is that important? Because to get back to Matt's point about planning, a lot of our local funding sources go back to sales taxes. And so sales taxes have a direct correlation to our economy. And so our two sales tax sources here, Transnet and our TDA funds, so our LTF and STA funds that come back to us. This graph right here isn't meant to represent what we're going to receive, but it's essentially, while we are predicting, when you do a forecast, you typically predict 3 to 4%, whatever it might be, and you just assume a constant increase every year. In reality, you'll have declines as recession hits. You'll have good years, you'll have bad years. But what you can plan for is that if you've got a financial plan in place for the near term and then the long term, you can proactively plan for those. And then when it occurs, you have a plan in place to react to those. And so that's really the importance of when we look at local funding sources, why we hit on that.
Question.
Yeah.
So do you factor in that sales tax is decreasing to a certain extent because of the internet?
So thank you for bringing that up. I have to make a great point. We actually do not provide economic forecasts. So this is just taken from a Transnet forecast. But you're absolutely right, is that the internet with the, especially with Amazon, there was some concerns about with their sales not getting the sales tax. There was the Wayfair agreement that sent the Wayfair lawsuit, which tried to clarify that. And that is becoming something that we're thinking about and trying to see what is going to be the impact of that on our sales tax collections. But to answer your question, it does feel like over time, the government is trying to address that to make sure that if there is a sale, those sales taxes flow back to the appropriate jurisdiction. But it was a problem to the point where in our documents that we gave investors when we sold bonds, we had to disclose the internet is affecting our sales tax collections. Does that answer your question?
I guess I just have more of a statement to add, is that there's other disruptive transit options. We learned this, I learned this phrase at the recent Sandag retreat. You know, we have Waze, we have Waze now. We have TNCs, Uber and Lyft. We've got, apps that are changing things and autonomous cars and all this other technology that's coming down the pike. I don't know, does that factor into any of your decisions or any of your projections or what it is you're trying to tell us here today? That there's other outside things that, happen all of a sudden that we didn't see what was coming. I don't know how there's a way to prepare for that or I guess just have a plan and move forward.
Well,
hunker down. I don't know.
So we're responsible for that. There are a couple of items that you're approving on the board agenda today. One is the item that is combined with our land use study is our strategic multimodal transit study, which is geared towards helping us figure out what we're going to do from a transit point of view, leaning forward. So that's how we're looking at this issue. And I would tell you, Supervisor Desmond, there are bigger trends that are going to be impacting both highways and transit in the future. And I think I'll spend more time talking about that to the board because some of this discussion about modal discussions are going to be likely engulfed by bigger economic discussions about the U.S. from population growth to budget management to other things, which will likely be even bigger issues than the transit versus roads debate, because the big premise of this country in capitalism is an ever-growing economy, which is premised on ever-growing capitalists with more money to spend. So it's a bigger discussion. These guys do financial forecasting with us, but I'm more than happy to engage in some of that other discussion as we have future board members meetings.
You got us off the hook. Thank you.
Yeah.
I appreciate that.
I got told. Okay.
That's right.
I'm sorry, didn't you also kind of address that with your slide 14, the trends within the transit industry? You touched on the fact that there's ridership trends by mode, those sort of things. So I'm assuming you are factoring it in, or at least it's in your consciousness.
It's in our consciousness. And again, we're not providing or generating the forecast. So, but it's something more that as some of our transit clients look at their CIP needs, they factor in, well, first mile is a problem for us. Well, how does technology help us solve that? We take that information and say, okay, based off the capital plan that you've generated and how you're trying to use technology to get more riders to your system through Uber, through Lyft, whatever it might be, how can we help fund your capital program at the cheapest cost. So as Matt mentioned, we're very targeted in terms of how we look at these things, what we take from it. I can't tell you how you should use Uber to benefit your system. I can tell you with your capital program how we can fund that most appropriately.
Thank you. Thank you.
Sure. So taking a step back, we've sort of spoken about federal funding, state funding, local funding, the impact to NCTD specifically, and the sort of punchline question, what are you trying to tell us here? I think we're just trying to lay out a framework, knowing that some folks are new to the transit world, transit funding. So part of this is just an open discussion and sharing of information without a hard punchline, and sort of counter to our nature. Usually we come and talk about, okay, now's a good time to borrow for the following reason. Now's a good time to pursue this new funding source for the following. We're not quite going there. We're just talking about broad framework of federal, state, local funding and how it impacts you, so that as you go through and think about specific decisions, you're starting to weave together a broader understanding. And then big picture, I mean, transit's fascinating. Coming from KPMG, we had a whole set of group that just did their transit ridership forecasting. Those were interesting men and women. And they would build their fancy models, and I've had the luxury of a 20-year look back. So they would build their fancy models and say, if we build this line, we expect ridership to be here in 2020. So everybody's always wrong. And the questions that you're raising, a lot of the transit the transit planning ridership folks will have to think about. You got separate folks that do the economic forecasting for a 30-year forecast. They have to think about a set of things. Trying to just provide a little context to all that. Driving us home here on page 32, just thinking about financing considerations. To be honest, we don't expect NCTD to be doing a whole lot of financing, so I'm going to push through this somewhat quickly, but you could stop as we go through. Context as you think about borrowing are the following. Where do you stand today? What are your near-term needs? What cash resources do you have to address those near-term needs? It's usually best to use PayGo to minimize your borrowing costs. And so that forces us to look at liquidity. Then you look at your long-term needs. I can meet my bus acquisition needs today, but how is that going to factor into my needs 5, 10, 15 years down the road? And then your current debt obligations. What are your debt service payments currently? So we could start there on page 33. The district has $24.3 million of long-term obligations outstanding. That is it. The debt service is represented by those green bars. That's annual principal and interest. It slightly decreases over time, which is nice. It decreases from 2.2 million annual principal and interest to 1.9 million. So a very, I would say, conservative and low leverage, low amount of borrowing for the program. We look at metrics, and an important one is debt service coverage. I know folks like Supervisor Desmond has heard us talk about this ad nauseum at Sandag, but in terms of how strong your debt service coverage is, if we look at a 2017 metric, we really try to get to what is the agency's net revenues after you meet all of your operating expenses, net out depreciation. What do you have remaining to pay that debt service? Net revenues in 2017, for instance, was 4 million. Annual debt service was 2.3. For every dollar of debt service, you have $1.76 of net revenues to meet that. So you have some cushion, you have some coverage.
Question.
Yeah.
How does that compare to other transit agencies?
Good question. There's really two types of transit agencies from a funding perspective in the U.S. Those that have a dedicated tax to support operations and capital improvement. Denver, Utah, Dallas, Seattle, Portland. Most of those are sales taxes, but you have rental car taxes, you have payroll taxes in Portland. But it's a dedicated tax to help fund the system, primarily operations, and then that is used to support borrowings, debt issuances. Those tend to be in the AA, sometimes AAA rated, like LAMTA, AAA rated entity, because they're supported from the sales tax in that case. Here at NCTD, you do not. You are more like an AC Transit. San Francisco MTA does not have a dedicated tax. Caltrain, the commuter rail that runs from San Jose up to San Francisco, does not have a dedicated tax. And so they have to look at all the dollars that come in, TDA funds, federal funds, your local contribution from your ordinance dollars from SANDAG, first pay operations, and then there's net revenue. And so net revenue, let's face it, for transit agencies, most of the dollars are going to operations, and everybody gets that. And so there is not a ton of net revenue remaining. So I'll cite a third party. For S&P, if you have $2 for every dollar of debt service, that's very high in their opinion. So 2 times coverage from a net revenue. So at 1.76, and you look historically, you've topped 2, you're in a pretty good shape from a coverage standpoint, just from a coverage standpoint. And then the affordability reality as well, it's still only $4 million net revenue, right? If I got down to 1 times coverage, I can have $4 million of annual debt service. So that's your real constraint. We'll look at that in a minute. But
in the market and the rating agencies, they start to get concerned when that coverage ratio for a transit agency like yourselves drops below 1.5. So every situation is different and specific, but that's a general rule that people look at. If it's below 1.5, they will start to get concerned.
That said,
is there a trend here? I mean, are we heading towards the 1.5, or I just kind of see it from 13 to 17, and we're at 3.3 to 1.76. And there's probably a minimum guarantee. The 1.5 is a comfort zone, but there's probably like, I don't know, whenever the bonds or whatever the debt was released, there was a certain minimum that it had to stay above, I'm sure. I don't know if it's at the 1.5 or not, but I guess looking at the years ahead, are we leveling off, or are we going to continue the downward trend?
Good question. I think there's 2 takeaways. The concept of a trend is tricky. If you look at net revenue,
You're either going up or you're going down.
well, that's true, but you're going kind of both, right?
Well, I'm just looking between 13 and 17. It's
the one takeaway I would say is this: $1 million difference. Let me give you some context here. Your total operating expenses in 2017 is, let's call it $100 million. So $1 million swing here or there on net revenue, that's 1% of your operating expense. $1 million swing will have a significant impact on your coverage ratio. So we see no concern. The rating agencies, I think, will see no concern.
These are good numbers, but there seems to be.
Your debt service is going to be, for the most part, level going forward. There should not be a significant change in the amount you're paying for debt. It comes down to, from your operating side, what's your net revenue? So as you're generating your operating revenue, your sales tax, after you pay your OPEX, what's remaining? That part is going to be the determinant factor in your coverage.
So that's a variable moving forward.
Correct.
I guess we don't really know where that is.
Exactly.
As far as the operating
So
costs.
that goes back to the planning perspective when you're looking at planning.
I would put it like that. You put a sort of planning model in place. You have a number of things you're meeting. You got your needs. You got to put service out. You have some of these financial metrics that you have to keep your eye on, liquidity and coverage. Then you manage to that. It's not like you have a ton of sales tax dollars coming in. You could slow down your capital program. Or managing your operations is kind of what it's
But
all
all things, I guess, with no huge catastrophe, whatever. We should stay at this rate. It should be leveling off. Is kind of what I was looking for.
Well,
That type of an answer.
so they're giving you a general answer because this is what they provide. That's going to be more of a question for our CFO as we come forward with our 5-year budget, because there's a number of factors that we have to look at. And one of the, just so you know, this has been part of the discussions that you and I have, not the specific debt service coverage. We've been having more of a focused discussion on looking at our 5 and 10-year budget in a much more detailed way than we've done historically. And you're going to see some changes in our budget process. We're also very mindful of this is because I think we sat down with these guys and had a couple of hour presentation, and you and I, we both agreed. It's one of the reasons why we've chosen not to want to take on any more debt as an organization. And as you get into this presentation, I think a little bit more, you'll see the cost of debt, even at low interest rate levels, is quite expensive from an actual dollar outlay. So that's part of the strategies that you will hear from us as part of our budget. Because when we develop our annual budget, we also give you a 5-year and a 10-year budget forecast.
Okay, well, I guess we just got this morning, so I haven't really had a chance to absorb this. So.
Right, and keep in mind, this is not non-decisional. This is just a precursor to the beginning of our budget process.
Okay, thank you.
Good discussion. So 34, coverage is strong. We don't have forward-looking forecasts, so to your specific question, Supervisor Desmond, we can't tell you if it's planning to go down or not, but that's a good question. Big picture from a debt service coverage and a liquidity standpoint, that's on page 35. You're strong. It supports your sort of single A rating category. I mean, for those of you that sit on Sandag's board and committees and track their rating, they're AAA. They're AAA for two reasons. They don't have operating exposure. You're an entity that primarily does, and that dedicated tax provides strong coverage going forward. The two metrics that rating agencies will focus on you is coverage, but with more of a mind to keeping you at that 1.5 to 2 times, and the liquidity, and the goal for transit agencies that don't have a dedicated tax is to stay in that single A rating. There are no AAA rated transit agencies without a AA, without a dedicated tax. The highest rated transit agency is San Francisco MTA, the AA flat. So it's you're in a different world. You have a lot of operating exposure to Member Drucker's comment. You have metrics that you manage to largely through your operating budget. That's it. But the takeaway from 34 and 35 is within that context, as a transit agency, your financial metrics look strong and support strong ratings. We touched on the fact that financial planning is important to address all the questions that come up. What are our metrics today? What are our capital needs in the next 2 to 3 years? What are our capital needs over the next 10 years? Is there a wish list? Can we meet that wish list? What's the timing in which we could deliver these various projects? You do a good job already. Staff is already sort of engaged on long-term planning. I believe they're going to continue to talk to you about that. We bring this page up on 36, that as you think about capital needs and when you deliver service improvements, important to do that not just in a budgetary single or a 2-year view, but in a 5, 10, 20-year perspective. Financing options on 37, I realize we're running a little late here, so I'm going to move quickly through these. There's 3 categories of financing options. Short-term financing, which is really helping you deliver a capital project in anticipation of other dollars coming. It's kind of bridge financing. You expect federal or state grant funds to come in, but they're not coming in for 2 years. You might do some short-term borrowing. If you identify a permanent long-term shortfall for a project that costs $50 million and you only see 30, then you may need to borrow $20 million on a long-term basis. And then federal loans are a good way in which to access a low-cost long-term borrowing. So on 38, I'm going to move through fairly quickly because I'm sure we're kind of running out of bandwidth here to take on any more in the financing world here. We've laid out several financial products. There's quite a few words on the page in detail. I'm just going to tell you that an entity like yourself that's high rated could set up a commercial paper program if one needed sort of liquidity, short-term borrowing. It is going to be tied to the short-term part of the yield curve. And as Darren started, boy, that short-term part of the yield curve is pretty close to the 10-year mark on the yield curve. So 6, 7 years ago, we could go out and borrow commercial paper and the all-in cost would be about 0.5%. Today, it's about 2.5%, largely driven by the Fed funds, by the Federal Reserve moving up the short-term rates. So commercial paper and a bank line of credit, one is a publicly traded security, has quite a bit of documentation required. That's commercial paper. Bank line of credit makes sense for folks like yourselves. You can enter into a direct loan agreement with somebody like a U.S. Bank or Bank of America, draw on that, retire it when you no longer need the program. Rates for both of those are around 2.5% today. Bond anticipation notes don't make much sense in this case. It's a fixed rate note, but it's fixed and cannot be retired with quite as much flexibility. Those are 3 short-term borrowing options. Happy to answer any questions there. Holler at me if I'm going too quickly here. Long-term financing options. Revenue bonds, that's your traditional sales tax bond. Again, for the Sandag folks, that's the form in which they issue bonds or revenue bonds. A specific funding source is identified and securitized for the benefit of repayment to bondholders. NCTD has issued certificates of participation. That looks and feels much more like a lease agreement. There are lease payments made between NCTD and the California Transit Financing Corporation. Bondholders or COP holders have a interest in those lease payments. They receive a portion of those lease payments. The way it's set up, the reason it's set up that way for transit agencies is it allows you to bundle the broad set of revenue sources that you have. In this case, you receive contributions from Transnet, TDA funds. There's some federally eligible dollars that might flow and be permitted to be used for these payments. You could bundle them all and promise them through a covenant and appropriation to pay the lease payments. And so COPs work well for transit agencies. That's what you currently use. P3s, we put it out there. It's sometimes thought as free money from equity investors. I got to say, for toll roads with a specific revenue source, that may be the case. You might get investors that come in and take risk on whether revenues will be realized or not. We all saw how it played out at SBX in the South Bay, and that did not perform, and some of those equity investors took a loss. So in transit, it's not a profit-driven enterprise. So P3 is going to look and smell much differently. There's not going to be a whole lot of free money coming from the P3. It can be a very reasonable way to shift risk through project delivery. It's a quick flyby on a P3. And federal loan programs are good. They're sometimes onerous with again, the Mid-Coast project has a $540 million TIFIA loan. We access that TIFIA loan for an all-in rate for that 35-year borrowing at, I continue to forget, 2.4%. So that's the benefit of going through a federal program. You get a subsidized rate and some flexible repayment terms. So TIFIA is always worth thinking about for folks like you. RIF for commuter rail, similar, tied to the U.S. Treasury rate. It's the Railroad Infrastructure Financing Program that has not been used as much as the TIFIA loan program, but it's picking up some popularity. So there are federal programs. So that's a takeaway. There's a variety of products. It all comes down to it's got to be driven by your needs, what you can afford, and maintaining your metrics so you don't get in over your head. So that's that. We thank you for your patience in the discussion. That is all we have through 40 pages.
Additional questions? We'll wrap this up.
Yeah, so again, this is setting the stage for the budget process. So just to spend a moment in terms of next steps on the budget process. So there is an executive committee meeting, and at that meeting, I tend to outline some of the priorities for the district and some of the instructions that I've given to our CFO. Then there is the Performance Administration and Finance Committee. They will receive a presentation on kind of the broad outlines of the budget. And then we'll begin an iterative budget process with you all to share exactly what we expect the FY20 budget plus the additional 4 to 5 years beyond that to look like. So this is intended, again, as kind of the building process. Why this is important for you all is one of the considerations that I'm given to, or direction that I'm given to our staff, is we have to prepare based upon the current assumptions that we have for revenue, and we're going to do that. So right now things look good, and so we're going to develop a budget to assume that. But we also have to plan for the likelihood that there will be a recession that will take place sometime within this next 5-year period. Now, to give you guys a magnitude of things that can happen, our budget process, when I was coming into the district and we had the Great Recession, we were supposed to have received $52 million. And based upon the downturn in the economy, that revenue yield was $37 million. And so when that happens, I can assure you it is not fun. And so to make those kinds of adjustments for us, it's not a short-term activity or quick activity. So within this budget, we will start developing plans that we would be able to implement if we were to have to be in a position of having to reduce expenses. And for us, there's very limited places to go because we have contracts And mostly it will be service-related impacts and to the degree that we can on the small staff that we have. So that completes my discussion on this item.
The workshop is adjourned. We'll get started with the regular board meeting at 2:00. So there's some food over there and drinks.
Thanks again.
Thank you.